Marcy, has anybody ever told you that you're a five-tool player?
I can't say that they have. I don't even know what that means.
You're pretty,
Oh, thank you.
you're smart, you're kind, you're funny, and most importantly, you think I'm funny.
I
So
do.
that's why we're going to talk about the five most important features of an income strategy and how the SAGE method encompasses all of those features. I'm Mark McKay,
And I'm Marcy McKay.
and welcome to Sage Smart Solutions. Please join us weekly to learn new and exciting ways to protect your assets and retire tax-free. Okay, let's jump right into it and go to the slides with the five features of an ideal income strategy. All right, here we are. All five features of an ideal income strategy in one place. So what do you think my number one favorite feature of this ideal income strategy is?
Tax-free, baby.
Tax-free. I
Getting
hate.
Uncle Sam out of your wallet.
Let's see what if you're right. I figure out how PowerPoint works. Non-taxable. So I've got here cash withdrawals from our SAGE method are tax-free. I actually even have the IRS code here.
You do? Wow.
I still
At
have
the
not
bottom.
figured out how to make this little section. I forget if it's like capital and there's two of them, it's sections. Damn lawyers. Anyway, but this is I just copied the code. IRC Internal Revenue Code section 7702 and 7702A show that a properly structured cash value life insurance builds tax free. And when you pull the money out in the form of a loan, that is tax free. The multi-millions dollars that you're leaving to your heirs as a legacy benefit, that's tax free. So if you've got your IRA and you think, you know what, I'm good, I have $3 million in your IRA. No, you have $1.8 million in your IRA, and Uncle Sam has $1.2 million in your IRA. And every time you pull out, it's going to make your Social Security taxable. So you're just making Uncle Sam that much happier.
Why they're probably charging you fees for it as well.
We did a case study for a 50-year-old a couple of weeks ago. They were moving $200,000. They were going to need the money when they turned 66, and we were able to structure it so that they will have an $80,000 a year tax-free income stream, and it actually can grow a little bit. And we still have a big pool of money and the tax-free death benefit.
Gotta like that. So number one, taxable.
Number two, so taxable. If we wanted tax-free, we could just go put all our money into muni bonds and get our 2%, and we're good. If you can live off of 2%.
Right.
But we need growth. And when we structure this, because we're using safe leverage and compounding, we are able to show our clients, we can structure this so that they will have consistent double-digit tax advantage returns. And it won't be, it's not this, oh, we made 12% in our mutual fund last year, but we lost 20.
Right.
You don't have to worry about that with the SAGE method. We can get double-digit growth. We can beat the market without the market.
I love that. And I think what's super important about this is you never know what life's going to happen. I mean, you said these people were 50, need the money in 16 years. Who knows what their life's going to be like in 16 years?
Well, let's see what some of the other features are. So I went the wrong way. So low risk. That goes back to what we were saying, that we can get that, double-digit returns are not that hard to find.
Right.
But double-digit returns without the potential of double-digit losses are almost impossible to find. And we can show you on paper how we can structure this, once again, using safe leverage, using other people's dollars to slowly, consistently, but definitely build up towards those double-digit returns.
And to me, this is huge, because 16 years from now, or however long, do you want to pay for your granddaughter's wedding? Is there unforeseen illness that, is going to come up? You never know what's going to happen in life. So I think this one is super huge.
That's a good point. I was going to say, well, we have a slide devoted to all these things you're talking about, but risk is a factor of that, because you don't have flexibility If you put your money in the market 4 months ago,
Right.
do you feel like you have the flexibility to just
Nope.
pull it out now? Go back and look. We 3 months ago did did a video about don't fight the Fed.
Yeah.
Look where the market was then. We did one on Bitcoin crashing when it was over 30,000 and it had come, anyway. There's no reason to have that kind of volatility in your retirement accounts, in your income strategy.
Well, in life is stressful enough. Why do you want your retirement investments to be even more stressful?
Yeah.
You
Did you
know?
enjoy opening your second quarter 401k statements or
Exactly.
IRA statements?
Exactly. All right, let's check out number 4.
Accessible. Like we said, if you had all your money in these Dave Ramsey 12% mutual funds and they go down 30% like they have over the past 4 months, I don't know what mutual funds he's recommending specifically, but if you just paid that 5% fee that he says, or commission to go, because anyway, accessibility is something hands down. Because I mean, we can give you a checkbook.
Yeah.
So you've got this pool of money or a line of credit, and you can have a checkbook access to it. You don't have to go and look and say, "Oh, do I want to sell the overseas balanced equity fund?"
Or you have to jump through, 7 different hoops to get access to your money. I mean,
or
you
eat a
truly
loss
do.
and pay a huge
Right.
tax
Get a
bill.
checkbook and use it at your own liking because it's your
It
money.
is your money. All right, so that was 4. We got one more.
Okay.
Flexible, because like Marcy says, life gets in the way.
Yeah.
Life happens. There are a number of ways when you call us, when you watch the Masterclass, link in the description below, 40 minutes long, very educational. When you watch that and then you set up your strategy session and we look at your plan, your first call, you'll give me a little bit of information. I will work with our team and put together a plan for you, and we'll set up a follow-up. But we'll go through actual spreadsheets saying, okay, well, if when you're 57, you need $22,000, this is what this will look like. If you're 63 and you need $100,000, that is what this will look like. And so you have that kind of flexibility. And because we structure these things correctly, if you've looked at an infinite banking product or design, let us show you this plan. We can make it so much more flexible. We get those high rates of return, which gives you flexibility because you've got more money than
Right.
if you had gone in the traditional be your own banker, infinite banking, or if you're in the stock market, we just got,
Absolutely.
which is in a bear market now. So
Absolutely. So I think a bonus number 6 is your passion about this.
well, I did in case my passion and the shot of espresso I just had made us go through the five ones a little too quickly. I got your old honorable mentions.
I like it.
So predictable. We can know at the beginning of the year, depending on how we structure this, but a lot of when we use the whole life
Yeah.
and cash value, we know ahead of time what the crediting rate for that policy is going to be. We know what the interest rates are going to be. That makes it so much easier to predict.
Yeah.
Did you know what the stock market, January 1st, 2022, did you know what the stock market
Yeah.
was going to do? We predicted it a few months ago, but
Yeah.
we didn't know.
Right.
Number 2, honorable mention, self-completing. This is actually a big one depending on your situation in life. But if you've got people that depend on you or you've got obligations and you think, well, I've got this plan, I'm going to put 7% of my income into my 401k for 25 years, and then this will provide for this. And then we go back to, Marcy doesn't ever like not my metaphors, but my examples of how you meet an early demise. She don't want to get hit by the bus. I don't want to go out lingering. So, but if something happens to the person in the breadwinner,
Yeah.
this auto completes.
Yeah.
So if you say, you know what, if we do this until we're 66 and then we can pull money out of it, but if you get hit by a bus when you're 53,
Right.
there's a big pool of money. I had a conversation with a buddy a couple of weeks ago, and his father had passed away, and he had several siblings and lots of relatives or whatever. And he kind of said, well, yeah, within a week I had a check for $500,000. And I thought,
Wow.
and I knew the assets that the patriarch of this family had, So I thought that, and it dawned on me. He went out and bought a $2 million life insurance policy, split it 4 ways, and that way
between his 4 kids,
they were able to, and then the rest, he let his lawyers handle the way he wanted to. But
right.
And then even on one of those, he put some restrictions.
Yeah.
And so it comes in the form of a monthly check.
Yeah.
So little Johnny didn't go blow it on bubble gum. So what else? That's also goes with
legacy.
That even if you live to 102, if you fund this correctly and you keep going with it, it is very easy to have what can turn into generational wealth.
Absolutely.
And you can say, well, I want my kids to have. Fine, give it to the church.
Right.
Give it to the little bunny rescue fund.
But
or set it up. Say, you know what? We want this to go into trust and provide college educations for all the kids, and they can draw.
Absolutely.
There are options there. I'm not going to give a statement.
Well, but I think we need to press pause for a moment. I know no one likes to think about their death or their loved ones passing, but
some people do.
Well,
both.
Okay, anyway, but the only thing certain is death and taxes. You have got to be prepared for the future. And so you have worked with so many people over the years who didn't have these conversations, and it's heartbreaking because it really can put some families in financial distress. So that's what I'm going to say. That go on to OPD.
OPD, other people's dollars. We are able to use leverage. This is if you have an asset that is predictably earning 5%, and it's such a safe asset. We're going to go ahead and include the next one.
Tier 1.
It's a tier 1 asset that lenders will loan against it at very favorable rates. Just keep doing it, and then pretty soon that 5% becomes 12%.
Right.
Because you've got that safe leverage. Now, I'm not talking about the kind of leverage that got Goldman Sachs and Merrill Lynch and everybody in trouble in 2008 and 2001. We're talking about safe leverage because you're using the asset, the tier 1 asset as collateral to buy more of the tier 1 asset as collateral. It allows you to buy more of the tier 1 asset as collateral. But it's not going to go like this with the stock market.
No, because it's not tied to the
watch the masterclass.
Right. Protect your assets.
And retire tax-free. Links right below. It will send you to you enter your email. We'll send you a link to the video. We won't spam you after that.
And we won't even be able to see if you've watched it or not. So this is just on your own time. It's your own leisure. See, it's very educational. See if we're a good fit for you, and then go from there. That's what I love about it. But yeah.
And now is the time. Interest rates are working in your favor for this type of planning. Interest rates and the Fed are working against you for the 60-40, 60-30, 10, whatever kind of stock, bond, growth, mutual fund, ETFs.
Right. There are smarter, safer ways
definitely
to protect your family and grow your family's financial future.
Watch the masterclass. Link is in the description below. Schedule your strategy session. Let's protect your assets. Let's get Uncle Sam out of your retirement plan, out of your income strategy,
out of your wallet.
Have a great week.